Hello everyone. In today's video, I'm going to talk about the AT&T Management Pension Benefit. Now you have a couple of options for your pension at AT&T. There is the lump sum and there's the monthly annuity. But before I get into that, I want to talk about how you become service pension eligible. Now to become service pension eligible, you have to meet the modified rule of 75. And the two factors that go into the modified rule of 75 are your age and your years of service. And they must meet a couple of thresholds and add up to 75. So if you have 25 years of service and you're age 50, you meet the modified rule of 75. If you're age 55 and have 20 years of service, again, 55 plus 20 adds up to 75, you do meet the modified rule of 75. Now there are a couple of caveats here. You can't just have any numbers that add up to 75. You do have to meet these thresholds. So if you're age 52 and you have 23 years of service, yes, 52 and 23 adds up to 75, but you are not service pension eligible because you don't meet both thresholds. The other thing is, if you have 30 years of service, you are automatically service pension eligible. It doesn't matter your age. But if you are under the age of 55, there is a 3% discount for your pension for each year that you're under 55. So if you were age 53 when you retire, but you have at least 30 years of service, you do have a 6% discount on your pension then. So something to bear in mind. As I mentioned, you do have a couple of options when it comes to your pension benefit: the monthly annuity and the lump sum. With the monthly annuity, it's a little more clear-cut. If you do choose this option, you don't have to worry about stock market risk. You're going to get the same dollar amount each month if you do choose this option. But that's something I want to point out. There is no inflation adjustment. So if your first check from the monthly annuity is $2,000, well, 25 years from now, that check is still going to be $2,000 a month. The lump sum does offer more flexibility. You can roll it into an IRA. You can go ahead and take out as much money as you need. You're not subject to $2,000 a month, like the example I gave with the monthly annuity. Say you need a larger one-time purchase, such as a new car or repairing your roof. Well, you can go ahead and do this and withdraw as much as you need out of the IRA. Another benefit is your beneficiary options if you go with a lump sum. Again, let's say you roll it over to an IRA. Well, you can choose whoever you want as your beneficiary. With the monthly annuity, only your spouse can get a benefit after you pass away. With the lump sum, you can choose your children to get the money after you pass away, if you'd like. Another benefit of the lump sum is if you roll it over to an IRA, that is your money. It's no longer affiliated with AT&T, so there is no credit risk. If anything happens to AT&T, you don't have to worry about it. Your IRA money has nothing to do with them anymore. So beneficiaries, flexibility of withdrawing as much as you need, and again, not having to worry about what happens to AT&T are a few benefits of going with the lump sum. Again, one more thing I want to point out with the lump sum is its relationship with interest rates. So interest rates and lump sums have an inverse relationship. This means that as interest rates go up, lump sums go down, and vice versa. So let's say interest rates go up 2% in a year. Well, that means lump sum values are going to go down around 20%. So it's something to keep in mind. It's certainly something we are keeping track of at all times. And we will always be sure to let you know what effect staying or leaving will have on your lump sum benefit. So if you do choose this option, it's something to consider, and certainly something we can help you with. Thank you for watching this video, and I hope you learned something today.